Right, there we go.
I'll go on mute as well, big man, for you. All right.
What's that?
I'll just mute myself as well for you. My dog's
All
snoring
right,
then.
fuck up. Cheers, mate. Thank you. Nice stuff. Cool. All right, guys. Well, thank you everyone for joining. Obviously, the call's been recorded, so you can listen back over this whenever you want. Um, what we're going to do things a little bit differently from last week. I'm going to start off by going over some basics of how I trade, so my basic strategy. So obviously, this can be quite helpful for you guys because when we send a signal, of course, like I mentioned last week, you can't always get the exact same entry, right? So it's kind of helpful if one, you can set up your charts in a similar way for my specific trades, and you can set all of this up yourself on TradingView. It will only take a couple of minutes. You can do it whilst you're on the call, or you can watch back the recording and add the same indicators which I use. It will allow you to basically execute trades without having, without basically seeing some context, right, and learning the strategy as you're copying trades, which ultimately that's what you want to do, so you can trade for yourself as well long term, which is one of the benefits of having trading as a skill. So what we're going to do, I'm going to start very, very basic. Now, there are four, or I say four, there's five different indicators I use. I'm going to turn off this one for now because it's going to make the chart look a lot cleaner, right? And we're going to go over the three main indicators because these two, this order block indicator and this smart money concepts indicator, essentially do the same thing. If I was to choose one over the other, I would always choose this order block indicator, which is why I'm starting with that. So, quite simply, how do I approach the market? Well, all I'm looking for is first of all to establish what the trend is, and then I want to take trades in the direction of that trend, right? So if we go to a 5 minute chart, which is where I'd always start, right? Let's zoom out. It doesn't take a fucking genius to understand that this is a bullish trend, right? Because
Yeah.
price is going up. Very, very straightforward. And you can zoom out high, you can go on a high time frame, like the hour time frame, you see the exact same thing, right? So the trend is bullish, which means for me, when I approach gold and when I approach trading gold, I would probably say I've got an 80% bias towards taking buy positions. So what I mean by that is I'm only going to take a sell position if I am very, very confident on that trade. Whereas I might enter, I'm going to take basically 80% of my trades are more likely to be buys, 20% are more likely to be sells. I'm leaning much more towards looking for buys, right? Why is that? Because, well, the market's going up. So you'd be kind of stupid to be just trying to sell or to sell and buy 50-50, right? You're much like, if you just, let's just make this point really clear. If you were to throw a dart at this chart, yeah, and let's say you're shit at darts, you're not Luke Littler. So you just launch a dart at this chart and it might hit anywhere. You're more likely to win that trade if you buy at that point rather than sell, right? Common sense because price is going up. So you kind of get, I want to be looking for buy entries, right? So that's the first thing I do. That's not really going to change too much day to day. However, it's important to establish the trend in the morning. So I wake up this morning, I can see, okay, over Asia session, price is going up. I'm looking for buy entries. Now, today, for our actual trading day, price hasn't really done anything. It's gone sideways, but I'm still favoring buy entries. Okay. That's the first thing. So I'm looking for long positions. Now, there's four different, well, let's do the indicators first, right? So I use this indicator here, which is an EMA. What EMA stands for is exponential moving average. So a moving average basically just averages the chart. That's really, really simple. So if we look at this 5 minute chart, each candlestick is what counted as obviously one candlestick. And if you look at my settings for my EMA, right, I've got these three. So that's the 50, the 50, the 100 and 200. If I turn on this one, it would give me the 20 as well. I don't personally use the 20. If you do want to use a lower EMA, I would use 21 rather than 20. It just is better, but I don't use that. Right? So you can see I've got green, amber, and red lines. Those three lines are exponential moving average. So the green line is a 50 EMA. All that means is at the point right now where our EMA is, it's taking the average of the last 50 candles and plotting it there. Same if we go to our EMA, but back here, for example, at this point, the last 50 candles average out here. So all this is doing is an average of the last 50 candles at any given point in time. And the exact same thing for the orange, because that's 100 EMA, is the average of the last 100 candles. And the red is the average of the last 200 candles, because it's a 200 EMA. Now, all this really does, and this is kind of very similar to the VWAP, which is the thick purple line, which I'll get into in a minute. but it's giving us an average price, yeah? And why is that important? Well, let's think about this really logically. If you want to buy or sell anything, right? You want to buy it at a fair price, right? You don't want to buy gold when it's extremely high above the average price, would you? You'd much rather buy gold at the average price. Does that kind of make sense? Because the average price is the fair price, right? That's what gold is really truly valued at. So when you see price running off up here, way above our EMAs, you'd be kind of stupid to buy at that point, right? You'd much rather buy at the average. And we can see this here. Like if you look, let's zoom out. You can see here, we've got a test on our red EMA here. We're testing our green EMA here, bouncing here, bouncing here. So if we look at these bounce points, they're at average price, right? Like here again, here, 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 here. Does that kind of make sense? I'm going to mute whoever's I can hear quickly. Cool. That's basically what an EMA is, right? All I would think about it is as a support zone or a resistance zone if you're in a downtrend, right? But obviously gold's in an uptrend, so our EMAs are going to be below. Likewise, if we just go to an asset which is in a downtrend, right? So let's go silver. This is basically gold against silver, which I don't want to confuse you too much. So ignore that. But you get the point. The only reason I'm showing you this is you can see that our EMAs are above price, which means we're in a downtrend. Really, really straightforward. Now, I'm not going to do too much more on EMAs. I could speak about EMAs for the next 2 hours, but that kind of gives you a crash course overview of what an EMA is, right? So when I mention that in anything in the chat, then you kind of know what an EMA is. VWAP, we're moving on to next. VWAP stands for volume weighted average price and it's basically very similar. However, it's anchored on different time frames. So if I look at my settings here, you can see I'm anchored on the session, whereas we can anchor on week, month, quarter, year. So basically, this is the average fair price for that trading session. Okay, that's all that purple line is. Now, there's various different ways you can calculate this. This is the setting I use if you want to use this on your chart as well. VWAP is another really good tool to use basically as another way. When price reverts to the VWAP, right? So like right here, we know we're at a fair price. So if we're in an uptrend, this could be a good idea to think about buying. This doesn't mean every time, like it doesn't mean we buy here, for example, right? Yeah, it doesn't mean we're going to enter a buy right now because it's here. But I would be thinking, okay, well now price is at a fair price. I can consider buy entries. Then I will look to analyze the market further. Okay. That's VWAP. Very straightforward. You can think of it very similar to EMAs if you like. And this order block indicator is basically showing us where order blocks are. Now, I would. Oh, we've got a drawing. It looks like a little fucking smiley face. Yeah, boy. Right. Anyway, whoever added that, thank you. How do I can't. I don't know how to rub out drawings. Who knows? Anyway, let's carry on. So, what is an order block? Right, an order block is there's a misconception about order blocks. Let's start with that. That I'm, if you guys have known me for a long time, I'm very vocally against the whole smart money concept strategy and the whole ICT strategy. For me personally, I think it's a load of bullshit. And well, not bullshit. I think it's the whole context behind how it's taught is exaggerated. However, order blocks is something that I would agree on a little bit more. Stuff like fair value gaps and all that kind of stuff, I think is total bollocks. If that worked for you, you can use it, but for me, I wouldn't even waste my time. Now, an order block simply doesn't mean that there are orders in that area. It's just marking out areas where there could be institutional orders. Now, why could there be institutional order? Like how is this indicator basically ascertaining that there are institutional orders there? Let's think about this logically again. As a big player with multi-millions, billions of pounds to trade in the market, well, one, how they can't just buy or sell with that large volume at any given moment in time, right? Because there's liquidity in the market. So if an institution was to come in and place a massive buy order, what would happen is price would just absolutely skyrocket. Yeah, they would get slipped and they wouldn't enter at a fair price. So we're moving back to our VWAP here, yeah? So what an institutional trading desk will do, to make this really simple, say you work at Goldman Sachs, right? And you're a trader. What will happen is a client will call up and say to the broker, I want to buy gold and I want to buy $2 million worth of gold. So what the trader will then do, they can't execute a $2 million order on gold at once because what happens, like I just said, price will just rocket and they'll get slipped on price. So what do? They try to buy gold throughout the day and execute that in multiple smaller orders, which don't massively move the market, right? So they enter at a fair value. And this is why VWAP is used, because it's an average price. So what institutional desks will do is they'll generally buy when price returns to the volume weighted average price. You see they're buying here, 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 and here, right? See all the points where price has reverted to this purple line are generally all pretty good entries, right? If you were to buy here, you would have done all right. Again, you would have done all right. Again, you would have done all right. Here, you may have gone into a little bit of drawdown, but they're entering physical orders, right? They're not trading with big leverage like us. So this is why you can't just enter every time here, because obviously you'd have to have a fairly big stop loss, 75 down to 53. It's 170 pips stop. So we need to build it more into our strategy, but we know this is what institution is doing. So all an order block is an area where it's likely that big players have orders. Now, why is that? Well, because, oh, holy shit, what the fuck happened there? There we go, fixed. Right, how's the best way to describe this? When price is not really doing much, right? So when we have a candle like this, where what we call a doji candle, right? And then you get a big move one way or the other. Well, an institution is like can potentially execute an order in a scenario like this. Why? Because there's not much going on in the market. So it's a good time to buy, right? Because you don't want to be buying where there's loads of sellers. So at a point where price isn't doing much like this, is a good time for a big player to come in and push price one way or the other, which is why you sometimes will see a massive move after an indecision candle like this. That is what an order block is, because they've executed their buy orders within this area, which has then pushed price up. A retail player like myself or any of you guys can't push price up like this very, very quickly. Yeah?
Hey, bro. Sorry,
Hey,
I'm late.
no stress at all, bro.
Yeah, sorry.
I'm going to do another like 10, 15 minutes and then I'll pass over to you if there's anything you want to cover.
Oh,
Uh,
okay, perfect.
So, like as an institutional trading desk, well, sorry, as a retail player, we can't move price this quickly, which is why this is an order block, right? But the institution can't execute all of their orders at that point. So what we see is when price comes back into this area, then they're executing again at the same price, right? They're layering their entries within this zone, which is why we can see rejections here. Now, again, this isn't a foolproof strategy, and this is probably what Baptiste might cover a little bit off. This is a very similar indicator, a smart money concepts indicator. And as you can see, right, where my indicator shows an order block, we've also got this indicator showing an order block here as well. The reason why, personally, for me, I prefer this first one is because it's a little bit more specific. Now, strictly speaking, without getting into too much detail, an order block is an inside candle before that big move, which means if this candle was bullish, right, even though it's an indecision candle, and then the move is bullish, this isn't an order block by definition. However, this indicator will show other, like for example, here, right? This is well, this one's fine. These are all fine, in fact, but this won't show the last candle. So, for example, for me, this isn't a bullish order block because the last candle before the big impulse move is bullish. Does that kind of make sense? But you can use either or. So that's all three indicators I use. They are all essentially areas of support or resistance, right? They're just dynamic levels of support or resistance. So if we look at this, let me just look at this one for argument. Actually, I want to leave this here. But I presume you guys know what support or resistance is, but to be really simple in case you don't, a resistance is something that's resisting price, like up here, for example, or right here, right? You see price is bouncing off this area, so it's a ceiling on price, and the support is simply the exact opposite, right? It's something that's supporting price below. So all these three indicators that I've shown you are basically just a support and resistance level. You can use them as exactly that. The only other indicator I use is this one down here. This is a stochastic RSI, which is basically a slightly more complicated RSI. But what this is an oscillating indicator. Why is it oscillating? Because well, if you know what the term oscillating is, you'll understand. But if you don't know what oscillating means, this will kind of explain. It's basically moving up and down. It's kind of like a heartbeat, you can guess call it. It's moving up and down within this set defined range. Okay, between 100 and 0. If you use something like a MACD, then it's a slightly different range. But for relative strength index RSI or stochastic, or this one, which is stochastic RSI, which is a mixture of the both, it will oscillate between 100 and 0. This blue box in the middle is basically the middle area where it's not really telling us much. But if we look at, I'm going to draw vertical lines here, when price is above this blue box, okay? Or here and here. Right, let's do these four for example. What this is basically telling us is we've had an extended move to the upside. So price is what we call overbought, right? Which is a signal that potentially we're going to have a sell-off soon. See if we look here, price is above the zone and both of these have crossed over and we get a sell-off. Again back here, and actually strictly speaking, we should move this over to where they cross. Yeah. Price sells off. Here, they cross here, and you can see we've moved up a little bit here. So it's not a foolproof rule, right? And if we go here and move this one across to the cross, right, then price sells off from here. So it says that we're layering confluences, right? And this is what trading's all about. Without context in the market, you're just buying or selling whenever price goes up or down. You are just gambling. However, we can just see here with the last four examples where price has crossed above this box, yeah, price has sold off on 3 out of 4 of those scenarios. And again, you can look at it the other way around if you wish. When price crossed here, we moved up. This is below the box. Crossed, sorry, these crossed here. Price went up. Here they crossed below. Price went up. And here it's looking like we're about to cross. So the likelihood here, I mean, I'm not going to personally trade on this is outside my trading session. But if I were to analyze this chart right now, well, I can see what's happening. Let's look at this in a bit more detail. One, this is crossing, right? So we know out of the last 3 times when these crossed below the box, right, making it really simple, when price was oversold, price went up. Secondly, we've got this green box here, which I've drawn on, right? What can we see here? When price comes to this zone, there's friction. Price doesn't generally just shoot straight through this, yeah? If I were to draw this zone just to show you what I mean, in the middle of this, yeah? Price goes straight through it, straight through it, straight through it. Okay, it's bouncing a little bit here, but it generally moves straight through that zone. Whereas here you can see when price comes, there's support here, then price breaks. Then there's resistance here, there's resistance here. We break. Support, 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 support. We break. Resistance, resistance. We break. Support. And then we've had it disrespected here. Yeah. So I know there's a support level here. You can see what price is doing right now. Like as I'm talking about this, price is rising, right? Because we've come back to our VWAP. We've got a support zone. Our stochastic is telling us price is oversold. This is a good potential entry if you were to be trading right now. Now, I won't get into too much more. I could layer this much, much deeper. I wouldn't have personally entered this trade, right? Because for me, what I like to see is then how price is delivered into that zone. And what I mean by that is what the candle's doing. So in a scenario like this is a buy entry for me any day of the week, right? Compared to this. What is the difference between, let's arrow marker here, this and this, right? What is the difference? Does anyone know? If not, I'll crack on.
Is the second option not like an engulfing candle in the kind of the first one? It's more like the doji candle, what you said. So it's obviously giving you a confirmation that it's going to go to the upside based off of the support.
100%, yeah. So for me, I want in this entry, right? So let's go to the second option. at this point, when this can, because I can say, oh yeah, this is a great time to buy, but we have hindsight that price has moved up here, right? So, you wouldn't take a fucking genius to say, oh, this was a great point to buy because, well, but we wouldn't know that when we entered down here. At this point, when this last bearish candle, which is the black candle, right, closes, I'm not going to be buying there because the amount of momentum that's come into that level, for me, I think it's pretty likely that price breaks through that level. Yeah, because we've come to that level with a lot of momentum. Now, by this point, so what I wait for my next candle. Then we've engulfed it, right? By this point, well then how do I set up a trade here? Because I'm going to be buying up here. My stop loss needs to be down here, right? It needs to be below that zone. And then where am I targeting? So for me, I'm looking at this. I'm putting a trade together. I'm like, well, actually, all I can really target is like somewhere here, really, because we're in a consolidation zone all day. So this is a shit trade, right? Because you've got a big stop loss, and there's not really much scope for upside based on what price has been doing today. Whereas if we compare that to this first one, and Dylan, you're exactly right, we closed with a doji here. I much prefer this because we've moved into the zone with big momentum. I'm not going to place a trade after this black candle because why? We've come in with big selling pressure. We could just sell straight through this. The fact that this candle has closed as a doji, what's that telling me? Well, it's telling me the sellers which were here in this particular time span are no longer interested in selling past this zone. They were interested in selling up here at this price, which is what pushed price down, but sellers are no longer interested in selling. Otherwise, what would happen? Otherwise, they would continue to sell and price would continue to go down, right? So this doji candle basically is my entry signal for a trade like this. And you can see why this is much better because our stop loss will be below the zone, right? Mine's always 60 pips, but you get the idea. Zoom out again. We target somewhere between the highs, and you can see our risk reward on this trade is much better. So this is kind of a whistle stop tour of what I kind of do on a day-to-day basis. And I would add, this probably sounds really simple, and it is a lot more complex, but this is like the bare bones, right? Of the technical side of the strategy. Then you need to obviously think about what's going on in the world. Like if we've got news, what's going on, if there's been any announcements. So, like for example, last night when I said gold is going to shoot up on market open and Japanese yen cross pairs are going to sell off on market open, that was nothing to do with me looking at any chart. I don't even need to look at a chart to tell you that. Because I'm looking at what's gone on over the weekend. What are the headlines? Okay, I know that's what direction those assets are going to go. Gold was going to go up because of obviously what was going on in terms of predictions of a US government shutdown, and yen was going to drop on expectations of a Japanese central bank yen intervention, basically. And if you don't know what that is, then read up, and I explained that yesterday in the chat. So that's basically a whistle stop tour of my strategy. Does anyone have any questions on that? First of all,
Are there any other confirmation candles apart from the doji that you'd be looking for?
good question. In an ideal world, I want to see a doji candle. In some instances, I mean, this isn't necessarily an entry, but if I see like a big move down like this, and then we push up and have a large lower wick like this, then again, like maybe I'll enter before the doji. Like in this scenario, again here, like I mean, this is a doji really, but all I really want to see is that there's some sort of resistance to the selling pressure that's come into that zone, or the buying pressure that's come into that zone. So here, like the fact that we've come into this and instantly pushed back up, like buyers have taken over and pushed, like sellers have pushed price all the way down to here, and
There
buyers
seems
have,
to be quite a few. There seems to be quite a few throughout, so it seems to be like a consistent indication, like
yeah,
of the little crosses. Small
100%.
like wick. Small like
Yeah, yeah, it's just a small bodied candle, basically, is a doji. If we want to get a little bit more like technical, I'm just going to kind of draw um what do we want, array, right? If the doji look like this is the body and this is the wick, and there's no upper wick, then that's fucking in a buying scenario. That is the best fucking case scenario. Yeah, if the doji looks like this, because all that is showing us is sellers tried to push price all the way down here and were unsuccessful and push price back up. Yeah. But I won't get into that now because otherwise I feel like I'm overloading with info. We can do that on another call. But I hope that answers your question, Dylan.
Yeah, for sure.
Right. Bat, do you have anything you want to go over?
No, nothing. I think everything is good.
Cool. Right.
Sorry.
In that case, I will. Um, what I'm going to do, I'm going to go over like an example for a layering trade, right? We'll do another 10 minutes and then I'll jump off. Obviously, this call's been recorded if anyone wants to listen to it back as well. Let's go to a 1 minute time. By the way, I'm not entering a trade now, so don't enter it. You can enter it on demo if you like, if you want to set up a demo account, but that's the pre-warning. Like, well, you can enter it on your live if you want, but there's no reason why I'm entering this, right? I'm just trying to give you an example. So let's say we're buying here, right? So I send in the trade to buy. The zone's going to be 77 to 73. Yeah, roughly like there. Because I said set the trade at 77. And you've seen the signal at this point, yeah? Price is within the zone here. So you can just safely enter at market. You're not going to be setting a buy or sell limit order at this specific moment in time, right? Because price is within the zone. Conversely, well, actually, I'll come over. I'll do an example in a minute when price starts to do something that allows me to make the example a bit clearer. Again, you could layer further into the zone here, right? So rather than setting a buy limit at 77, 76, 75, 74, 73, we're within the zone. So I would just be averaging price within this zone. Does that kind of make sense? So I would layer up to your maximum amount of entries in within that area. Now, obviously, for an example like this, we'll just do, so this was 77. So our first take profit would be roughly here, 79. It's not bang on the right number, but you get the picture. 73, so stop loss will be down here somewhere at 71. Right. Still, if you saw the trade here, so you're not always going to see it straight away. We're still within the zone. Now, let's say, because we don't want to spend all evening doing this, because price is just not doing well. Let's see. Let's wait. If it comes down lower, then this will emphasize the point. Go down lower. No, it's not going to, is it? If price was down here between our zone and the stop loss, then personally I wouldn't enter the trade. I'd be like, that's the likelihood is that trade's probably going to hit stop loss. So I personally would skip that one if you've seen it at this point. Like for example here, yeah, this is likely going to hit where the stop loss would be on this trade, so I wouldn't enter. Again, if price was outside the zone at this point, say it was up here somewhere, then in this scenario is where I would layer. Okay, so in this scenario, I'd set buy limit at 77, at 76, and so on and so forth, 75, 74, 73. And then you can let them get tapped in. The other thing is when we move break even, right? So let's say generally for my personal trades, and this different for the trades that Baptiste sends, because obviously we have slightly different intervals for take profits and stop losses, all that kind of thing. But the actual concept is the same. So once once the trade hits TP2, yeah, or the trade has hit stop loss here, that trade for me is invalid at that point. That entry is invalid. So if you go to see the trade and it's hit TP2 or it's hit stop loss, you just simply don't place that trade. Yeah, you wait for the next one. However, if it's hit TP1, I'm still happy for my personal trade. You can still set your trades and you can still enter it, right? If it's between the entry and TP2, somewhere below here, you can still enter that trade if it comes back into the zone. Yeah, and this is what I bang on about so many times. Like you see, for example, price will react and shoot up here, and I'll get a message like, "Can I still buy?" I'm like, "Well, you can do what the fuck you like." Do you know what I mean? I'm not got a gun to your head telling you no, but it's a bit stupid, really. If the trade is that we're buying here, yeah, why would you then enter up here? You've missed that trade by that point, yeah. And I think this is one thing that so many new people to trading come in, and they have that fear of missing out, and they want to take every trade, and ultimately they end up fucking themselves because you're placing trades at a point where there isn't a trade. Like by the time price has come all the way up here, and there's been a few examples today where price just rocketed. You just sit that trade out, unfortunately. because it just happens. Like me or Baptiste, we when we send the trade, like we don't know what price is going to do. Like we have an idea that we think we're sending the trade because we think price is going to go up or down, but I don't know if price is going to shoot up 100 pips in one candle or if it's going to take the next 10 minutes to go up. So we just send every trade that we see and we personally take. Not everyone you're going to be able to get in on, but we can't control that, right? So you've kind of got to use your own, your own intuition, I guess, or your own like thought behind it, and just use your brains a little bit. Like, if price is gone, or if price has hit the stop loss, or if, for example, we've moved stop loss to break even, then if you're placing that trade, you know, okay, you've got a bit more risk. Again, if you're placing the trade outside the zone, why is that a bad idea? Well, it just means your stop loss is way bigger, right? If you're placing up here, your stop loss is bigger than 60 pips, which is what I always send it in at. So you don't know what your risk is. You can't calculate your risk quickly without using FX calculator. But for gold, by the time you've done FX calculator, the trade's probably gone. So it's good to basically, that's why you should enter inside the zone. Now, second thing on this topic is let's talk about taking profits, right? Because that's also another very, very key thing with a layering strategy like this. I've got 3 minutes left on this meeting, so I'm going to try rattle this in a minute and a half, and then there's some time for questions. In a scenario like this, say this is the zone and price has filled the entire zone. What I'll generally do is when price comes back to break even, I'm going to close my entries at the top of the zone. So I would have had an entry at 72, say 71, and so on and so forth, right? 70, 69, 68. I would likely close these two at break even and then so close those two out, set my stop loss at break even at these entries down here, and then they're risk free. Yeah. And I've done that because really, when price fills that entire zone, it's a lower probability trade because I'm entering thinking price is going to bounce here. If it fills this entire zone, the probability of it continuing and hitting stop loss is higher. So I want to take risk out the trade, yeah? And that's basically why we set stop loss to break even. And again, you need to use a bit of common sense with it because everyone's going to have different entries. It's impossible we all have the exact same entries on every trade because there's slippage. The market moves, right? It doesn't just sit there every minute and not move till the next minute. It's continuously moving. So you need to think, okay, let's say, I'll do one more example. Oh, fuck, go off this. Fuck's sake. Oh, what is this stupid arrow doing? There we go. Cool. I want to go to arrow here. Right. Let's say, delete that one too. Let's say was our zone, yeah, and price filled half the zone. Then in this scenario, you don't want to close at TP1. Why? I hope someone knows. Because in that scenario, you're basically risking more. Oh, hold on. Why is this not showing? Or it's a one-to-one risk reward technically, but you get my point. You're basically risking the same amount that your profit target is, which isn't really an ideal scenario. You want to be taking more profit, right? So you shouldn't be closing at TP1. You should be waiting until like TP2 to close. So that kind of makes sense. There's less than a minute left on this before it shuts me out because I've not paid for Zoom Premium. I'll pay for it for next week. But does anyone have any questions before this shuts down? I hope that kind of makes a bit of sense.